Welcome to the Get Money Rich podcast, where we break down the complex financial concepts into easy to understand insights. I'm your host, Money, and I'm the blogger behind GetMoneyRich.com. Today, we are diving into an essential financial metric that every investor, entrepreneur, and business owner should understand: the debt to equity ratio. We will explore what it is, why it matters, and how to interpret it within different industry contexts. Let's start with the basics. The debt to equity ratio, often abbreviated as DE ratio, is a financial leverage metric that compares a company's total liabilities to its shareholders' equity. It's calculated using the formula total debt divided by total equity. In simple terms, it measures how much a, how much debt a company is using to finance its operations relative to the value of its equity. For example, if a company has, let's say, a 1 million in debt and 2 million in equity, then the debt to equity ratio would be 0.5. Now, you might be wondering, why is this ratio so important? Here are several reasons for it. Reason number one: financial stability. A lower DE ratio indicates that a company is less reliant on debt, which generally means it's more financially stable and less vulnerable to economic downturns and interest rate fluctuations. So, a low debt company will not be affected so much by the external factors. Reason number two: investor confidence. Investors and lenders often prefer companies with lower DE ratio as they are seen as less risky. A high DE ratio can be a red flag, suggesting potential difficulties in meeting debt obligations. Reason number three: industry standards. Different industries have different benchmarks for a good DE ratio. For instance, capital intensive industries like utilities, cement, steel might naturally have a very high DE ratio compared to a technology or service company, which typically have a lower ratio due to less need for heavy infrastructure investments. So, if we are dealing with a capital intensive industry, a company in capital intensive industry, they will have a high debt to equity ratio. Similarly, a company working in a service sector, they will have a lower DE ratio. So it varies. It doesn't mean that all companies should have a same kind of debt to equity ratio levels. It differs from industry to industry. Reason number four: a high DE ratio isn't always bad. For fast growing companies, especially in sectors like technology, using debt to finance rapid expansion can be a strategic move. It's all about how effectively the debt is used to generate returns. No matter how high is the balance sheet showing debt, if that debt is being used effectively and in turn the company is able to generate more revenues and more profits, even high debt can be considered good. Determining a good DE ratio depends on several factors, including the industry and the company's growth stage. However, some general guidelines can help. Let me tell you a few rule of thumb. A debt to equity ratio which is below 1.0, A debt to equity ratio between 1.0 is usually considered good as it indicates that the company has more equity than debt, which implies lower financial risk. Personally, when I code an algorithm for stock analysis, for my algorithm, it is essential that a company which is maybe it operates in a service sector, but if it has a debt equity ratio of zero point 0.3 or lower, I give it a high rating to that kind of company. Now, suppose the debt to equity ratio is between 1 and 2. This range is often acceptable for many industries. As a general rule of thumb, a debt to equity ratio between 1 and 2 is considered acceptable. It suggests a balanced approach to financing. See, a company operates which do not have any debt. Suppose it is a debt free company, but it is not growing. That is also not good. What investor wants, what the market needs, that okay, the company can take some debt, but at least it should show some decent growth. So if a company wants to grow fast, it may need some debt. So for those companies, that's why it's said that the debt to equity ratio between 1 and 2 is acceptable, provided the company is also growing reasonably fast. Third point, if the debt to equity ratio is above 2, ratios above 2 can be concerning unless the company operates in an industry where high capital expenditure is normal. For example, a, a cement based company, a company that produces steel, in utility company, these companies uh, tend to have a very high debt to equity ratio. So even for those companies, even 2 is not a very big uh, DE ratio. A company with a strong future growth prospects can justify the higher debt to equity ratio. So we must keep an eye on the debt to equity ratio, but also we must see how fast the revenue and the profits of the company is growing. If the growth is fast, it can justify the high DE ratio. For example, a utility company with a significant infrastructure cost might have a high DE ratio and still be considered financially healthy. Why? Because this company operates in a sector which is a very capital intensive sector. So we cannot compare a company like TCS and a company like Tata Motors and say that because TCS has a very low debt, it is better than Tata Motors. No, Tata Motors is a company which is a very capital intensive company. It will have more debt in its balance sheets. Let's look at how the DE ratio can vary across different industries. Capital intensive industries, sectors like utilities, telecommunications, and manufacturing often have a higher DE ratio due to substantial investments needed for infrastructure building. Here, a DE ratio of 2.5 might be standard. Service and technology industries. Companies in these sectors usually have lower DE ratio, often below 1.0, since they require less capital to operate. For instance, a technology company, let's say Wipro, HCL Technologies, TCS, Infosys, with a DE ratio of above 1.5 might raise a concern. Why it will raise a concern? Because these companies generally operate at a very low DE levels, maybe lower than zero point 0.1. Most of these companies are actually debt free. So if such companies display a DE ratio of above 1.5, it is a concern. So it depends on industry to industry. Cyclical industries. Industries such as automotive, cement, steel, construction can have fluctuating DE ratios. During economic booms, they might take on more debt to expand, and while during downturns, they reduce debt to stabilize finances. Understanding the debt to equity ratio is crucial for making informed decisions. Here are some practical applications of decision making. If we have to decide with a perspective from an investment analysis, investors use the DE ratio to assess a company's financial health and risk. Comparing the DE ratio of a company to its industry averages can provide insights into how well a company is managing its debt. Now, suppose we are viewing DE ratio in terms of a business strategy. Business owners can use DE ratio to make strategic decisions about financing. Balancing between debt and equity can help optimize growth while managing financial risk. Too much risk with a reasonable growth is not acceptable. So there should be a balance between how fast I can grow and how much financial risk I can carry on my shoulders. So this is a critical business strategy that entrepreneurs should uh, balance, and how they will balance by looking at the DE ratio. Now, lenders also look at the DE ratio to take a decision. Banks and other lenders like NBFCs consider DE ratio when evaluating loan applications. A lower ratio can increase the likelihood of securing a favorable loan terms. Means they might get a company which has a very low DE ratio might get favorable interest rates. So, to wrap up, its DE ratio is a powerful tool for understanding the company's financial leverage and risk. Remember, the key is to consider the industry context and company specific situation when evaluating the DE ratio. Do not apply the thumb rule that a DE ratio below 1 is good. No, it's not. We have to see in what stage the company is. If it is in a growing stage, it might need more debt. If the company is working in a capital intensive industry, it might need more debt. If a company is operating in a service sector but it is carrying a debt to equity ratio of 1.5, it is a concern. So we have to think holistically in deciding whether a company's debt to equity ratio is high or low. I hope you found this episode of the Get Money Rich podcast informative and helpful. Thank you for tuning in. If you have any questions or topics you would like us to cover in future episodes, feel free to reach out in the comment section below. Don't forget to subscribe and share this podcast with others who might benefit from our insights. Until next time, stay financially savvy.